fluctuation of interest rates, the difference between a fixed rate mortgage and an adjustable rate mortgage?
Oh, great question, because I get that a lot. When it comes to mortgages, a fixed rate mortgage means that for the term of the mortgage, typically 30 years, you're going to make a monthly payment, and that payment isn't going to change. Your interest rate isn't going to change, and so your monthly payment's not going to change. That's why we call it a fixed rate 30-year mortgage. Now, you can also get what are called adjustable rate mortgages, which have a fixed rate for a short period of time, and then they go to what's called an adjustable period. Now, that fixed rate period up front can be anywhere from 3 years, 5 years to 7 years, even 10 in some cases. And so that gives you a bit of a time to, maybe you can get a lower interest rate on an adjustable rate mortgage. And so if you expect you're going to be in an increasing rate environment, having a fixed rate for a period of time locks you in at a lower interest rate, and you're insulated from other rates in the marketplace going up. And especially it's good if you think maybe you're only going to be in this property for 5 years. It's not your forever home. And so you're going to be there a short time, and you just want to get that rate locked in. But once that fixed rate period is over, then it gets into what's called the adjustable period, where that interest rate could change on anywhere from a 6-month to an annual basis. So you beginning in that period, your monthly payment's going to change. And so you just need to be aware of that. You need to be on top of that. It doesn't necessarily have to go up. It could go down. So it could be in your favor one way or the other. Whatever rates are going to be like 5, 7, 10 years from now, you might be able to take advantage of it. But that's the key difference between a fixed rate and an adjustable rate is with adjustable, if you keep it long enough, your monthly payment could change.
And you mentioned it changes every 6 months or annually every 12 months.
Correct. But just depends on the loan that you get.
Okay, now let's talk about the difference between a conforming loan amount versus a jumbo loan amount.
Okay, another great question. So for a typical vanilla mortgage, the government, the federal government, and the government-sponsored entities have set sort of what the requirements are and the guidelines are for what kind of a mortgage qualifies for that. And they've also set a limit as to how big a mortgage can be to meet those requirements. And those are called the loan limits. So you might hear about conforming loan limits or conventional loan limits. That's what that means, is up to a certain loan amount. And we're not talking purchase price, we're talking loan amount. You can be either in the conventional conforming space or you're going to be in a jumbo space. And really that's the only distinction, right? And that can change based on the area. There's a national number, there's a national figure for what the maximum loan amount can be. Some high cost areas like ours, Pat, it can be higher. In our area, that limit is $1,089,000. If you need a loan for $1,089,001, you're in the jumbo category. It doesn't mean that your loan is in any way like worse than a conventional conforming, but you're into a different set of requirements. You're into varying guidelines and structures from what the standard sort of national standard would be. But that's really the only difference, is how much of a loan you need. That's what sets you on the jumbo versus the conventional conforming side.
Okay, now qualifying for a loan, what you had mentioned in the past, what do we care about? That's the bank and the underwriter and processors, right?
The most important thing, and this is one of the fallouts, or I shouldn't say fallout, but one of the important things that came out of the 2008 recession is that when it comes to qualifying for a home mortgage these days, we as the lenders, we have to be sure as best we can that you can afford this mortgage, right? That you can afford the monthly payment, and you're going to be able to continue to afford the monthly payment, down the road. Gone are the days when, you could ask for a loan of however much you wanted, and we didn't have to care whether you could afford it or not. That's all gone. That's never going to happen again. We have to be assured based on your income and your credit and your assets, the amount of money you have available, that you can afford to make these payments and continue to make the payments. So that's really what qualifying is all about, is just making sure, and it's for your protection, right? Making sure that you can afford this mortgage, so that 9 months down the road or a year down the road after you've purchased your home, suddenly you've run out of money. It's not going to work for you. We definitely want to avoid that happening. It's not our goal to get you in a position where you could ultimately lose your home.
Okay, now in terms of qualifying, that pre-approval versus pre-qualification, what's the difference?
So pre-qualification, you have to be careful because some lenders will treat these terms differently, but generically, a pre-qualification is you've sent me a loan application, you've told me how much you make, you told me how much money you have, you told me what you think your credit score is, and I've put it all together, looked at it, and said, you know what, to the best of what you've given me and the best that I know, we can probably get you the loan that you need. That's pre-qualification, right? It's just sort of a first pass. You've told me, and okay, based on that, it looks good. Pre-approval is, okay, now you got to back it up. You told me you have $100,000 in the bank. I need to see bank statements to prove it. You told me your credit score is 740. I have to pull a credit report to be sure about that. Right? You told me you're making $150,000 a year. I need to see bank statements, pay stubs. I need to be pre-approved. I've got to have the documentation that backs up what you told me on your application. And if everything works out, it's all provable, what you told me is true, then I'm going to take your application. I'm going to do a very automated first pass through an underwriting system. And if it says you are good to go, then you're pre-approved. You can go out there and you can start buying a home.
Great. And I know that you have, you work with a lot of realtors, of course, and you have particular different classes that you teach. So I plan to have you back real soon. I hope you put us in the schedule and we will go through the whole A to Z process of home buying.
Yep. I would love to do that with you, Pat.
Okay. I know you have a hard stop. Again, Jeff, introduce yourself and the name of your company.
I'm Jeff with Guild Mortgage here in Morgan Hill in the Bay Area. You can contact me anytime. Would love to talk with you.
And what's your phone number?
408-825-0222.
Great. Thanks again, Jeff.
All right. Good talking with you, Pat.